Upbeat, professional intro music plays briefly, then fades under voice, "Welcome back to Forex Trading Board, the channel built for the charts by the charts." No fluff, just the framework for trading excellence. 90%. It's the statistic you know by heart, the ghost in every trader's terminal. But what if I told you that the why behind it isn't about indicators or even psychology 101? It's about a fundamental architectural flaw in how most approach the market itself, flaw that, once seen, separates the 90% from the 10% permanently. Let's cut past the surface-level excuses. The 90% don't lose because of spread or bad luck. They fail because they operate within a framework designed to fail. The core issue is onto lack of discipline, though. That S, the symptom at S, a lack of an edge. Defined with surgical precision, the losing majority trades in a vague space of hope and reaction. The expert trader, however, trades a defined statistical expectation. The chasm between these two approaches is where capital evaporates. Think about it. Most traders spend 95% of their effort on the entry signal, the perfect candle pattern or indicator confluence. But for the expert, the entry is merely the logistical step. The real architecture lies in the risk framework and the probabilistic outcome over a series of events, not a single trade. The 90% are hunting for certainty in an inherently uncertain environment. The 10% are managing uncertainty through rigid position sizing and understanding that their edge is a negative expectancy filter. They know which losses are acceptable within their system, while the majority rationalize every loss as an anomaly. This leads to the second critical failure point: adaptive versus static strategies. The market's DNA is change. The 90% often find a method, practice it in a specific regime, and then cling to it like dogma as volatility shifts and liquidity profiles change. The expert trader understands that a strategy has a cyclical shelf life. Their key skill isn't just executing a plan, but knowing when the market's structural parameters have invalidated the plan's premise. They are not married to a bias. They are managers of capital under dynamic conditions. Finally, and this is the silent killer for experienced traders, egocentric accounting. The 90% track their P&L in a way that reinforces bad behavior, focusing on win rate, clinging to losing trades to avoid a realized loss, or taking premature profits on winners to be right. The expert's ledger is based on the quality of execution relative to the system's rules. A well-executed loss is a successful trade. A poorly executed win is a failure. This shift from outcome-based to process-based performance is the final firewall. So, ask yourself, are you building an architecture for sustainability? Or are you just placing bets and hoping the statistics don't apply to you? The market doesn't care about your hope. If this reframe hit home, then you're already in the minority. Smash that like button. It helps the algorithm separate the signal from the noise. Subscribe and hit the notification bell, because next week we redeconstructing the myth of high probability setups and what that term really means for your equity curve. Drop a comment below. What S1 architectural rule in your trading plan that you defend above all else? Until next time, this is Forex Trading Board. Trade aware, trade prepared.